Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, stocks are falling, fast enough that the financial media is cranking its crash alert. But I'm going to show you proof of what's coming is one of the best buying opportunities of this year. I'm going to reveal why the bull market is going to keep charging and the 7 stocks I'm loading up on when others scream sell. Stick around and I'll update you on shares of Nvidia, NVDA, supermicrocomputer ticker SMCI, and answer the AI bubble question once and for all in our stock market outlook. Let's get right into those stocks to buy though, because stocks in the S&P 500 may only be down 2.7% from their all-time high, but investor fear is out of control. The VIX Volatility Index, that market's main fear gauge, jumped to its highest since April, and the Fear and Greed Index is at 22, into extreme fear territory. Against this fear and the market sell-off though, I've bought over $300,000 in stock over the last 2 weeks, and I'm closely watching the market for more buy-the-dip opportunities. Now, to understand why I'm still buying, you just need to understand the difference between a correction and a stock market crash, and then the proof that I'm going to show you later that this recent sell-off is going to be an opportunity to buy the dip. A stock market crash or a bear market is anytime stocks fall 20% or more from their recent highs. Using the S&P 500 stock market index and its peak of 6920 reached late October, a crash would see it down to 5536 on that index, so a lot further to go. A correction, though, is when stocks fall less than that 20%. Sometimes it's when they've fallen 5% or more, and sometimes only when they've fallen 10% do we call it a correction, but always 10 to 20% from that top. Now, going back to 1950, we've seen only 10 real stock market crashes or bear markets, while corrections of more than 10% have been much more frequent. 36 times the index has fallen at least 10% from that peak. In fact, of the 56 times that stocks have fallen more than that 10% from their peak, all the way back to 1929, about once every 2 years, only 22 of those have become a bear market of 20% or more down. So now being able to tell when it's just a correction and won't become a crash has meant big returns for investors. Buying the dip on the last 9 corrections would have made you an average 18% return over the following year, with only one correction in 2022 seeing losses after that. After the most recent correction in 2023, where stocks fell 16% in the 2 months to October, the market jumped 41% over the following year. I'm going to detail why I believe this is just a correction and what I'm buying next, but even if this is a correction, we could have more pain ahead, so I want to walk you through what to expect. Studying past corrections, we see that the average time from the top of the market to the bottom of the correction is around 71 days. That is just over 10 weeks and could mean stocks continue to fall into the first week of next year from their peak of October 28th. We also see an average drop in these of 15% from the peak, which could mean the S&P 500 index falls to 5840 on that index, quite a bit lower than where we are right now. And as bad as that sounds, it could be even worse for investors in tech and AI-related stocks. When the S&P 500 fell into correction territory in March of this year on those fears leading up to the tariffs, all but one of the Magnificent 7 tech stocks had fallen much more. This group of tech heavyweights fell an average 16%, with Tesla down 33% into that correction. And right now to last Thursday, with the S&P 500 down just 2% from its peak, some of the hottest names in tech were down a lot more. Nvidia has managed to squeak out a gain, but Broadcom is down 4.5%, and others are down double digits. So Nation, you need to be ready for more pain ahead in some of those stocks, especially if the correction drags out over weeks and falls even further. But there is very good reason to believe that this is just that, a correction, and your buying opportunity into 2026. Now, all you out there in the nation know I'm an economics nerd to my core, so that's where I always go for the big picture ideas that could separate a correction from a crash. While the jobs picture is weakening, unemployment is still very close to its lows at 4.3% reported in August. Now, we will probably see that increase when the next report comes out on December 5th, but it's still nowhere close to the recession-level unemployment. Then, company earnings just reported for the third quarter were extremely great, with companies in the S&P 500, so those 500 largest companies in the United States, reporting profits rose 13% from last year. This is way above the 8% growth analysts expected to be reported. With the exception of a few sectors of the economy, like consumer staples, energy, and communications, profits were strong, with tech companies reporting earnings that were 27% higher from last year. With the big market fear that tech companies and AI specifically are expensive or won't be able to live up to those expectations, that 27% earnings growth goes a long way to putting those fears to rest. Now, earnings for this quarter to be reported starting late January are expected to slow down to growth of just 7.5%, but that's likely to be beaten just like last quarter's, and next year's growth of 13.7% expected should support stock prices. Even if we do see the economy weaken a little, the Fed has a lot of room to lower interest rates. The central bank has already cut its benchmark rate by 1.5% over the last year. Market expectations for another cut in December have moved to just 50-50. That is part of the reason for last week's sell-off, but the Fed is still expected to cut rates at least 3 times through July of next year. If the economy does weaken further, we could see even more cuts than that, and which would lower the cost of borrowing for businesses and consumers and prop up the economy. And beyond all this, if we do see a strain on the economy or stocks, we're likely to see the government step in and try to prop things up. We all know that President Trump measures his success largely on the stock market, and we've just seen last Friday that he's planning some tariff cuts to lower those food prices. Nation, yes, stocks are pricey on some of the valuation measures that we follow here on the channel, and even an average correction would mean a lot more pain left in this sell-off. But we just don't see the kind of clues that this is going to become a full-blown stock market crash. At 67.34 on the S&P 500, stocks are now down about 2.7% from their peak. I would be waiting for the index to get down a little further to about 65.75, which would be 5% down before I start really picking up stocks. Even then though, I'd still want to hold some cash back and wait to see if stocks get down to that correction territory of about 10% or about 62.28 on the S&P 500 index. At that point, I would start being even more aggressive buying my favorite stocks. And you don't have to be chasing every hot new stock. Just look at what's already in your portfolio. In this dip, I'm looking through my favorite growth themes, that AI, stablecoins, and cybersecurity to target the stocks I want to load up even more on. One of the hardest hit, down 30% in just the past month, is also one of my favorites, shares of Super Microcomputer, ticker SMCI, and I took advantage of that dip below $35 to add to my position. This is the pure play stock on the AI theme and could be twice this much and would still be a good deal. And here, between the Grayscale Ethereum Mini Trust, the ETH, and the iShares Ethereum ETF, ticker ETHA, I've already got over 650,000 invested, but I'm using this opportunity to add exposure to Ethereum. We saw stablecoin payments double from last year, and we're still only getting started on that era of tokenization that's going to take Ethereum much higher. And in one of my favorite long-term themes, that cybersecurity, I've already got shares of CrowdStrike Holdings, ticker CRWD, Fortinet, FTNT, Zscaler, ticker ZS, Palo Alto Networks, ticker PANW, and Okta, OKTA, and I'd be picking up more of these on any dips. Next, I'm going to highlight the stocks I'm watching this week, but if you are worried about further pain in stocks, it is not too late to get protection. Gold is the biggest story of this year, up 47% on dollar debasement, unstoppable government spending, and inflation driving historic central bank buying as governments around the world rush to the safety and away from the dollar. In fact, commodities expert Ed Yardeni recently made his forecast for $10,000 an ounce, another 150% upside from here. Now, I've had a small part of my portfolio in gold for years. I wish it was more, but have now partnered with Money.com to highlight the best platforms for investing directly in physical gold. Click through the link I'll leave in the description. I've used American Hartford for its lowest price guarantee and up to $15,000 in free silver bonus, but check out all 4 platforms here, along with how to use a self-directed IRA to get the tax benefits as well. All of these are going to give you free shipping or storage of your physical gold, along with those other offers, so check out the link or scan the QR code here. Now on to the stocks I'm watching this week. First up, Nvidia, ticker NVDA, is going to determine the fate of the AI bubble when it reports earnings Wednesday, with analysts expecting a 56% increase in revenue, 54% in earnings. Management is expert at guiding forecasts and is sure to beat these numbers, but investors are going to be hanging on every word of the outlook and whether Nvidia can raise forecasts for 40% sales growth next year and $289 billion. AMD helped keep AI alive in its Analyst Day last week, forecasting 35% annualized revenue growth for the next several years and 60% growth in its data center business. Even on its dominance in chips, though, Nvidia is trading richly priced at 27 times sales, so I'd probably be buying some of the other AI related stocks into its earnings. If the company does beat expectations, its own stock may not move quite as much because of that price, but it's going to take the entire AI theme higher. Palo Alto Networks, ticker PANW, also going to be reporting earnings on Wednesday, and in my favorite long-term theme, that's cybersecurity. Palo Alto is the largest company I follow in that space, but also one of the slower growth names, with forecasts for just 14% sales growth this year. The shares of Fortinet, ticker FTNT, plunged as much as 12% on its earnings that, while beating expectations, did show investors that competition is lowering profitability and a weakening economy is bringing hesitancy in some of its corporate buyers. Now, if those fears are confirmed with PANW, we're likely to see the entire group take a hit, but again, I would be right there picking up more shares. Folks, this is a long-term, unstoppable theme, and you want to be involved in these cybersecurity names. Also here, Walmart, ticker WMT, is up 20% this year into its third quarter earnings report on Thursday. It's going to be watched closely for weakness in consumer spending. Expectations are really modest here for just 4% sales growth for the quarter and for the full year, so I don't see any reason the company can't beat this when it reports. A more interesting and what could be an upside surprise for the stock over the next few years is its new partnership with OpenAI announced just last month. Soon, ChatGPT is going to begin suggesting products and allowing purchases on the app, a move that could drive stronger revenue growth for Walmart. Showing you that big picture here with the Sector Spider Sector Tracker. 4 of the 11 stock sectors did manage to close higher last week, with energy and healthcare stocks pulling the overall S&P 500 index into positive territory. Strength was broad-based, with 20 of the 22 energy stocks and 44 of the 60 healthcare stocks closing higher. The stocks in both groups still trade for attractive valuations after having underperformed the market so far this year and should still provide some upside return and safety. But I'm also looking at shares of consumer staples companies, the sole losers with the group down 1.7% this year, but that could change very quickly following Friday's announcement of a tariff pause on a lot of those food imports. Some of the hardest hit stocks here, like Conagra Brands, ticker CAG, General Mills, GIS, and Campbell's Company, CPB, could start to rally as prices for their inputs decrease, so be ready for that. Updating our stock market outlook, the end of the government shutdown means we'll start seeing that economic data again. The canceled September jobs report is set to release this Thursday, though the government has said that the October report may never be released. The August jobs report, so the last one we saw before the shutdown, showed just 22,000 jobs created, and a private survey in October, the Challenger survey, showed a whopping 153,000 job cuts in October. So investors are going to be watching this Thursday, and then in November, that November jobs report when it's released December 5th for any signs of weakening further in the jobs market. Through the rest of this week, though, there won't be much in the way of important data to guide forecasts. We will hear from a lot of the Fed speakers, so the people on the Federal Reserve Board, which, like last week though, they're just going to say they can't commit to a December rate cut without the economic data. But the data we do get from now until December 5th, until that next meeting, should be weak enough to lock in another rate cut. More important to our market outlook than that near-term data, or even the bigger picture economic trends that I highlighted, is the reasoning why I think this AI infrastructure theme continues to support strong revenue growth and stocks. And stick with me here, because understand this and you're going to see why all the day-to-day noise just doesn't mean a thing. The AI theme is only getting started. Right now, every big tech company has an AI dream, whether it's business or consumer use. When someone uses AI, they're for the most part using those computing services at a data center, and that dream of giant demand has driven forecasts for data center workload to increase by 167% over the next 5 years. To give you an idea of that scale, for reference, the 137 gigawatts in additional energy consumption at data centers is enough to power 89 million homes for a year, so a huge demand increase. Now, to build out those data centers capable of delivering that dream, JP Morgan reports that 80 gigawatts of data centers have been planned this year alone, though only about 12%, about 10 gigawatts of that is under construction right now. The rest is all planned for the future. That build-out is more than double the rate from last year, and would only satisfy a fraction of the forecasted demand. But then these data centers, they aren't built overnight. Because of planning, permitting, and the backlog in hardware and power equipment, it can take from 18 months to up to 5 years depending on the size. This timeline in a presentation by data center lease company CoreWeave shows up to 4 years in planning, permitting, and construction of a data center. In fact, the CEO of GE Vernova, one of the biggest US manufacturers of electrical equipment used in these data centers, reports nearly all of his company's output is booked through 2028. So now we're going to come back to that timeline, but right now, lately the fear in AI has been who's going to pay for all this, the trillions of dollars planned spending for those data centers over the next few years. Consultant McKinsey estimates the AI buildout could cost upwards of $8 trillion just over the 5 years to 2030, and while that means boatloads of revenue and growth for companies in that theme, so those AI-related stocks, is the money even there to be spent? And part of that answer comes from the four hyperscalers, Amazon, Microsoft, Alphabet, and Meta platforms. Now these mega-cap tech giants, they offer cloud services, so data center as a service, along with using data centers for their own platforms, so they are spending hundreds of billions of dollars a quarter in the build-out. This graph of capital expenditures or capital investment at just these four companies rose to $110 billion just in the last 3 months, and all forecasted rates that would increase next year. Now, these companies have that money, together generating over $250 billion in free cash flow every single quarter. Now, another answer, though, is through life insurance and private credit markets. The Wall Street Journal reported that sale of annuities alone reached $345 billion in the first 9 months of this year, money that needs to be invested to earn a return and make those promised payments to retirees. So along with hundreds of billions of dollars from private credit investors and other services, contrary to all the fear-mongering online, there is no lack of money to pay for all these AI dreams. But then what about the other fear in AI stocks? That we're going to find that revenue and the profitability just isn't there in artificial intelligence, and that lack of return is going to dry up the deals and all this funding. JP Morgan estimates AI would have to generate an additional $650 billion a year in revenue just to make all this spending worth it. And the fear is, even with the best scenario, that kind of revenue generation is a long shot and it's going to pop the AI bubble sooner or later. Now, I'm not going to argue with that sooner or later idea, but if we do look back at the speed and the trend of things right now, the 70 gigawatts of data center construction already planned, the $400 billion plus in annual spending on data centers, and combine that with the years it takes to bring a data center capacity online, and then the years-long backlog in much of this necessary equipment and the hardware. If we take all of this together, then we see that there is no lack for money to pay for that AI buildout, and any disappointment in returns that would cause a rethink to that spending is going to be at least a year away. That infinite money glitch that is AI spending is going to continue to boost revenue for all of these stocks involved, including SMCI, Nvidia, AMD, and Broadcom, and any dip should be welcomed as a buy-in opportunity. Get up to $15,000 in free silver and protect your portfolio investing directly in physical gold with one of the sites I'll link to in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.